Greetings, everybody. Welcome to Liberty Call for January 6, 2025. Hope you're having a fantastical day out there. Bank stocks are on the rise after Fed regulator Michael Barr stepped down, signaling potential regulatory easing. Meanwhile, Citigroup's CEO is under pressure as the bank's stock lags behind, and Morgan Stanley continues to trend of big banks backing out of climate alliances. Ooh. On the economic front, manufacturing is showing slight improvement despite ongoing challenges, and United Health is projecting record-breaking performance for the year. Plenty to unpack, so let's jump in and make sense of today's market madness. All right, but before we do, I need you to do me a favor. If you could give me some thumbs up, a like, share, subscribe, a follow, and press the notification bell. All righty, well, let's jump into today's markets. Dow Jones was down 0.13%, 53 points, closed at 42,678. Big retracement from earlier today. It was way up. Let's see, SP 500 up 0.58%, 34 points, closed at 59,76. NASDAQ up 1.25%, 246 points, closed at 19,867. The VIX was down 0.5% today. It's at 1605. Canada down 0.29%, Brazil up 1.1%, and Mexico up 1.16%. Headed to Europe, Germany was up 1.53%, the UK up 0.31%, France up 2.24%, the Netherlands up 0.79%, Spain up 1.34%, Italy up 1.91%, Switzerland up 0.49%, and Portugal down 0.15%. Russian exchanges both red today, the MOEX down 0.44%, same with the RTSI. And the overnight markets, the Nikkei in Japan was down 1.47%, Australia up 0.08%, New Zealand up 0.67%. In China, the Shanghai was down 0.14%, Shenzhen Component down 0.12%, China A50 down 0.37%, DJ Shanghai down 0.19%, Hang Seng down 0.36%, and the Taiwan weighted up 2.79%. All right, good stuff. All right, let's hop into the weekly economic update. Stocks edged lower last week despite a powerful end-of-week rally. The SP 500 lost 0.48%. The NASDAQ slid 0.51%. The Dow Jones Industrial Average fell 0.6%, and overseas markets dropped 0.9%. Selling than buying. Stocks were under pressure right out of the gate on Monday for no apparent reason other than worries over the loss of year-end momentum. By the end of the trading on Monday, markets recovered some losses, but the selling picked up again on Tuesday. After being closed for the New Year's holiday, stocks opened higher for the first trading day of 2025, but sellers gained the upper hand by the end of the trading. On Friday, investors perked up with tech stocks leading a recovery rally that erased most of the week's losses. All right, mega cap, mega influence. Mega cap tech stocks have captured many headlines over the past 2 years as the SP 500 posted double-digit returns, 24% for 23 and 23% for 2024. And for good reason, mega cap stocks were doing most of the work. For example, during the past 12 months of trading, more than half, 53% of the SP 500's return can be attributed to the Magnificent Seven, the 7 mega cap tech companies that most investors would consider household names. All right. Economic data this week. On Monday, Fed official Lisa Cook is speaking and factory orders. Tuesday, we have Fed official Thomas Barkin is speaking and the International Trade in Goods and Services. Wednesday, FOMC minutes are released. The ADP employment report and Fed official Christopher Waller is speaking. Thursday, the stock market's closed for President Carter's funeral. Oh, darn. And Friday, employment situation and consumer sentiment. And companies reporting earnings this week. Wednesday is Jefferies Financial Group. Thursday is Infosys and Constellation Brands. Friday is Bank of America, Wells Fargo, BlackRock, and Delta Airlines. All right, so that's all the news for the weekly update. Let's hop into today's market recap. Wall Street advances on hopes for selective Trump tariffs. All right, Wall Street's major indexes rose to more than 1 week highs on Monday, driven by a rally in semiconductor stocks and a report indicating that President-elect Donald Trump's administration may take a more measured approach to tariffs than previously feared. Automakers saw gains, with Ford rising 1.6% and General Motors up 3.37% after a newspaper suggested Trump might impose tariffs selectively on sectors critical to national security. Though Trump later denied watering down his tariff plans, markets reacted positively to the possibility of a less aggressive stance. The Russell 2000 index, tracking small cap companies focused on the U.S. economy, rose 0.78%, reflecting optimism about domestic economic growth. 8 of the S&P 500 11 sectors advanced, with communication services leading gains at 1.73%. Chip makers surged after Microsoft announced an $80 billion investment in AI-powered data centers, and Foxconn reported stronger than expected revenue. NVIDIA gained 4.54%, AMD added 3.77%, and Micron Technology soared 12.15%, driving the Philadelphia Semiconductor Index to a 2-month high with a gain of 3.45%. Stocks had rebounded sharply on Friday after December losses, driven by concerns over high valuations, rising treasury yields, and thin liquidity. As investors await more clarity on Trump's policies, the market remains focused on upcoming economic data and speeches from Federal Reserve officials. While Trump's proposals are expected to boost corporate profits and the economy, inflation risks linger. Fed Governor Lisa Cook warned that inflation could remain a challenge, tempering optimism about potential rate cuts. Well, maybe you shouldn't have cut rates a year ago and just left them high for a while. That probably would have done more good for the economy. Citigroup rose 3.15% after receiving a bullish rating from Barclays, and bank stocks overall rose 0.88%. Fed Vice Chair of Supervision Michael Barr announced his resignation, easing concerns over stricter regulations for major banks. Markets will be closed Thursday for a national day of mourning. Yeah, I'm very sad. In honor of former President Jimmy Peanuts, the S&P 500 recorded 8 new 52-week highs and 6 new lows, while the NASDAQ posted 88 new highs and 27 new lows. All right. Closing down the market for Jimmy Carter. Gosh, it's just unreal. All right. Next up, we got an article from Zero Hedge. Dollars share of global reserves hits 30-year low as central banks pile into gold and alternates. All right. The U.S. dollar share of as a global reserve currency continues to decline, reaching its lowest level since 1994 at 57.4%. According to the IMF's Q3 2024 COFR data, central banks worldwide are diversifying their reserves by increasing holdings in other currencies and gold. This marks a steady decline from the dollar's peak share of 66% in 2015. If the current pace continues, the dollar's share could drop below 50% by 2034. Oh, no. Despite this decline, foreign central banks have not been dumping U.S. Treasury securities. In fact, foreign holdings of U.S. Treasuries reached a record $8.67 trillion, increasing by $880 billion over the past year. The total global foreign exchange reserves, including U.S. dollar-denominated assets, rose to $12.7 trillion. Among reserve currencies, the euro remains the second most significant, holding a steady 20% share. Other currencies include the Japanese yen, 5.8%, British pound, 5%, and non-traditional reserve currencies like the Australian and Canadian dollars have gained share at the expense of the dollar. Surprisingly, the Chinese renminbi has seen limited adoption as a reserve currency due to capital controls and convertibility issues. Gold has emerged as a significant reserve asset. Central banks, which previously reduced gold holdings, have reversed course in the past decade. As of 2024, global central bank reserves amount to 1.6 billion troy ounces, or about $3.8 trillion. The shifting reserve landscape highlights global diversification from USD assets, driven by factors like higher yields in non-USD assets and increasing liquidity in alternative currencies. However, the dollar remains dominant due to its role in global trade and financial systems, and the fact that our military will blow up your country if you don't use the dollar. So that might have something to do with it too. All right, last up, we got the Monday Morning Outlook from Brian Westbury at First Trust. This week's article is titled 2025, A Year of Promises and Paybacks. All right. The 2025 economic outlook is fraught with uncertainty, similar to the unpredictability seen in sports and politics this year. The college football playoff saw unexpected upsets, and Wall Street underestimated the S&P 500's 2024 performance, and most election forecasts missed Donald Trump's significant political shift. Now, forecasting 2025's economy is equally challenging. The U.S. has been running massive $2 trillion budget deficits annually, with government and healthcare sectors driving half of the job growth. Inflation remains stubborn, prompting the Federal Reserve to reduce its expected 2025 rate cuts from 100 basis points down to 50. Meanwhile, the incoming Trump administration is pushing for significant spending cuts, extending tax reductions, and stricter immigration policies. Economists warn that cutting the deficit will likely trigger a mild recession as government stimulus fades. The U.S. economy, previously cushioned by massive COVID era spending and money supply growth, could see real GDP decline of 0.5% to 1% and corporate profit disappointments. The Treasury's $750 billion cash reserve could momentarily boost money supply, but inflation is expected to remain elevated, with the consumer price index rising between 2.5% to 3%. The S&P 500 is currently overvalued by about 20%, and while another 20% plus stock gains is unlikely, the index is expected to finish 2025 between 5,000 and 5,400 points. Global uncertainties, particularly China's economic troubles and geopolitical tensions, add further risks. Trump's focus on fiscal discipline and reduced regulation could eventually bolster long-term growth. However, the market's high valuation and potential economic slowdown suggest that the road to prosperity won't be as smooth as it was during the early 1980s under Reagan. The U.S. economy still needs to reckon with the consequences of recent policies, and 2025 may be the year that reality really sets in. I doubt it. The people in Washington will continue to kick the can, kick the ball, whatever, and until it eventually just falls apart. I mean, I wish it would happen tomorrow, but I don't foresee that occurring here in the near future. All right. Well, that's everything that I had to cover for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All your financial planning needs can be addressed there. So give me a call, buzz, whatever you want to call it, and I'll be happy to help. All right. Well, like I said, that's everything that I had to cover for today. Hope everyone has a wonderful evening, and I'll talk to everyone again next time. Adios.